Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. I am joined on the podcast today by my friend, your friend, the nicest guy to ever appear on this podcast, Corey Shepard.
The nicest guy ever. Haven't we? We've had some pretty nice people. I'm trying to think of some of the guests that we've had. There must have been someone.
In the comments below, name one person that's been on the show nicer than Corey. And you know you can't say me because I'm not. Okay. And you're going to find out today because of the article that we're going to look at. Y'all, this is gold. This is where you're going to see me probably get pulled back a little by Corey. So sit down, hang on. We're going to talk about how people have invested in all these little real estate partnerships, and the promise for like the last several years for many of these is you can put in a small amount of money and own a huge chunk or a little chunk of a huge apartment complex. Look, your income is diversified by all of these doors. Right. We handle everything: property management, revamping, construction, remodeling. We're going to raise rents for you. Everything's going to be great. And we're going to double your money in a matter of years. And would you believe it, Corey, that the promises didn't quite end up like the results?
End up the way. And that's I guess lesson number one is be very careful who you listen to on YouTube. us included.
Right. Yeah. And if you want some evidence of that and how we've talked about that on the show before, go back and find our episode on Be Your Own Fiduciary. In fact, Miranda, if you could pull that up and throw it in the chat here, I'll take a look at it, maybe grab that, the Be Your Own Fiduciary episode. Because you have to be your own fiduciary, even though we are a fiduciary, we ask our clients to make sure they understand their decisions before taking action. Now, in this case, we have seen clients lose money in these kinds of deals. And I want to talk, before we talk about this particular article and this particular real estate developer down in Houston, or syndicator in Houston, what happens when you buy these kinds of deals? So you put your money in, and the plan is they acquire the project. They may do some remodeling. They plan on raising rents, and then they will refinance and give you a cash out to give your principal back, and then you have income forever. Or they'll say, we're going to do this for 3 to 5 years, and then we're just going to sell it, and you're going to get your capital gain. That's the two major ways these deals go.
Both of those outcomes would be potentially great outcomes for folks.
Yep. And the way that people intend it to work, Corey, because we've seen clients go through this, they go into it and they say, I'm going to put in this money, and then I'm going to put in $250,000, and I think I'm going to get $450 to $500 in 3 to 5 years. And then you get maybe some updates, maybe not as many updates as you want, but here's why people are attracted to these. They're attracted in part because they don't see the volatility. You see, most of the other assets you're going to buy, let's say your 401k at work, you can go online every day and experience the volatility for yourself. The market goes up and down. We don't know when it's going to go up and down. The people that do say when it's going to go up and down, it's just as hard to, in fact, harder to predict which one of those people will be right than it is to predict when the market will go up and down. So you have people who want to get away from the volatility, so they go into this real estate stuff. And the only difference is these real estate syndicates, you just get your volatility all at one time. Right?
All bunched up. It's like that water balloon, or like they turned off the hose. It's the pressure's building behind there. You just open the spigot and it
that's it. And
rushes out all at once.
Rushes out or sucks up more capital at the end, which I'll explain. And that is that we have one client who had a deal that was supposed to turn out in like 3 years. And, because of building permits and some other things that didn't happen. And then it went through COVID, and now it's been almost 7 years. And 7 years over which the 250 they put in was supposed to turn into 500. And because of difficulties with the project, higher interest rates than anticipated, and all of COVID cost overruns, the entire equity that they have in the project might evaporate when they have to fire sell it, because even though it's almost fully leased, it's still losing money every single month. That's a real problem with these, because what you're doing is you're putting your money in and then you're trusting that real estate syndicator's black box to produce the returns for you. And one of the hardest things about it is they could tell you it's all going well the entire time, and then you just find out it didn't work. And so you experience all the volatility at once. And from our clients that have gone through it, it's super difficult. It's not like all the volatility at once feels good, because you didn't see the daily movement and the slow progressive growth of, say, the stock market over 7 or 8 years. You just assume it's going well, and then you find out all your capital's gone, or 50% of your capital's gone. And that's the case here with these projects we're going to talk about. And when I saw this article, Corey, I at first thought this article had to do with individual investors like buying one or two unit individual apartment homes. But
that's been all over the news. Like lots of people trying to do that with Airbnb, helping you rent things out for.
Did I just say apartment homes? I meant rental homes, that people go in and buy an individual rental home. And you're right. There are lots of articles about that. But what they're talking about is people that were offered the benefits of owning apartment building rentals without any of the work in real estate investments that have already left some people empty-handed. So that's the attraction. I'm going to get to participate in real estate and real estate-like returns. And I'm going to do that through this, and I'm not going to have any work. Now, there's a lot of reasons that I don't know we'll have time to get into today about why that doesn't work. And maybe our next episode, Corey, we should just talk about the origin of returns and your human capital involvement. We haven't covered that in years. So we're going to visit this article and what went wrong in a different kind of way, which is
can we talk about real estate syndicators for just a second for everybody that might not know?
Oh, thank you, Corey.
That term, right? So and this is in that article as well, but they're going to buy the property, usually not with their own money. They're getting financing and then attract outside investors to help, either, frankly, pay the debt service on this thing, part of it, but add money for upgrades to be able to increase rent. And so they're just sitting here in the middle, taking fees from either like upfront fees for getting your money in and ongoing management fees, just like they were managing some kind of investment fund on this property, whether it's going up or down. And I think that is a big difference. They can actually make a lot of money, even if this property is going under and failing.
Well, not to mention, many of them will keep an interest in the overall general partnership for the work of putting it together. So they have, say, quote unquote, 20% of the deal, they might say, but they got 20% of the deal for putting the deal together, not like they necessarily put in 20% of it with their own money.
They could have. I suppose some do. And in fact, if someone had put their own money into the deal at the front end, it would lead me to have more promise on that. Like I'd be less suspicious. But a mutual fund, say some company is putting together a collection of stocks to sell you a mutual fund, at least if the value is going down, they're making less and less money each year. A syndicator like this could be making the same.
Yeah, because they're just making rent cash flow on, say, rents or something like that, and may not even have to do with profitability. So you got to read those syndication agreements closely.
Yeah. So let's look at your example of one, Paul.
So this is Jay Gajavelli, I think is how I say his name. He's going to say it here in a moment, and he's going to walk us through this apartment complex he's having people invest in. Now, this was made early 2022. So this video is a little over a year old. And I'm going to give away a spoiler alert here, Corey.
Oh, good. I was going to ask you to do a little, we'll call it foreshadowing.
Foreshadowing. There we go. So foreshadowing, this has already been foreclosed on. Investor money, gone. Like foreclosed on by the lender, already sold to an investment group. Okay. But let's see what Jay has to say about it. We're going to
Can
pause.
we show the picture in the article again real quick?
Nope. We're going to get to that when he shows the pool.
Wow.
Oh, I guess he's got it right here, doesn't he? Yes. Okay.
It's
Corey,
right
you're
there.
right.
That's why.
Yep.
Yeah.
I see,
That's
Corey.
why I was like, that's my poor gentleman. That pool is the same pool in his picture
as this one. This is the pool around the time of foreclosure. And we're going to talk more about some of the things said in the Wall Street Journal article and some of these others about this asset that he is saying people should buy into. And we'll see what his plans were for it versus actuals and how you can kind of pick up on some of this. For instance, I don't know that I would want to put a lot of money sight unseen for somebody that only been doing it for a series of years and not like decades when they're using literally what must be the least expensive green screen chroma key system I've ever seen. And you'll see that as he starts talking.
Hi, my name is Jay Gajavelli. I'm a founder and CEO of Apple's Way Investment Group, and we invest in cash flowing apartment buildings. And also we provide passive income to our investors, ongoing passive income. Today, I'm going to talk about an excellent passive income opportunity for you. That property name is Timber Ridge Apartment. You see the pictures on the screen.
Now, just so you guys don't think I pulled this just from the pictures, I'm going to show you guys in this article that it is the Timber Ridge Apartments and thought they would double investor returns by raising rents. Okay, so it's the same apartment complex. It's not just like Paul's really crafty and Corey are super good at picking out how apartment buildings look from a distance.
Beautiful 704 unit complex located in a thriving Houston market. As a matter of fact, Houston is one of the top 10 markets in the nation. We are investing in a great market and the property is well located right across.
One of the top 10 what markets? Like top 10 most expensive markets? Well, then that's not a great deal to buy into. Like it's things that sound like they should be good things, but when you think about the entire definition of like, there's no context for what he's saying. Like he's going to talk about, I remember doubling income. We'll watch for that one.
Well, I think what you're picking up on too, Corey, is it's the difference between he's not giving us facts. He's got some fact he's referencing. He's giving us his opinion or assessment about that fact, but he's not sharing the fact. So back to our video.
The highway exposure. Easy for tenants to get in and
Cross
get
the
out.
highway from what?
And also property comes with
it's got highway exposure.
I'm going to talk about.
Now, some people would say that means it's near a highway, so you're going to hear that all day long. But we're going to spin in that a little bit. Like it's super easy for people to park.
A few things, and first thing is property comes with classic interiors. They're not upgraded. We're putting money around $5,000 to $6,000 each unit, and we upgrade the interiors, and we raise the rent $150. More than what.
Corey, you brought up an interesting point on this part of, we're going to put $6,000 per unit.
Yeah. So what is that? Like $1,600, 12. Yeah. Something like.
So $1,800 a year.
Yeah. $1,800 a year.
Uh-huh.
So if you're spending $5,000 to $6,000, like just that right away is like a 3-year break even.
3-year recapture. If it's your money doing now, maybe it's a better ratio if I'm borrowing money to do it. That's a possibility.
Then it's right.
But I do love. I mean, it's just classic. These have a classic interior. They've not been upgraded. Like that's another way of saying inside these things are old. Okay.
Yeah.
What it is now. Not only that, increasing rent, but we increase other income also, like providing better amenities for tenant. Like
better amenities.
Carports, we build them. $30 we charge them per month. And we build private backyards, we charge them $75. And also we rent washer dryer to the tenants, we charge them $50. So together these
So we're going to add some benefits and charge for them. So we're going to charge for these washer dryers. We're going to charge for private backyards. We're going to charge for carports. But what he's like, we'll be more profitable and we'll have more revenue. Yes. But he said nothing about the cost of all those things.
Right.
Yeah. So is $75 a month the appropriate amount to charge for a backyard? I don't know, because I don't know what it's going to take you to make them. Now, granted, this is a promo video, guys. So we're not smashing on anybody should have this level of detail at this point. But we do have the benefit of hindsight in this case that this one flat failed and got foreclosed on. And so we have the hindsight to realize that now he's saying these things and this is how it's going to go. And it doesn't necessarily go that way.
Better amenities that our property, income increases every month after month. Not only increase income.
So right there, our property increases month after month. Now, again, a softer way to say that would be, we plan on making these changes over the next 2.5 years, and we should see consistent rent increases until then. Then the remaining leases will probably be 9 months on average. We'll get the remaining lease increases the year following that. But to say the rent rolls and profitability goes up every single month is naive at best. Because we've talked about this before. When you buy real estate, you are not buying a investment. You are buying a business. And in this business, this guy's running it. And your job is to put the money in and hope he makes all the right decisions. But it's a business, and businesses do not get more profitable dependably every single month. Corey, you sound like you're going to say something.
The article talked about his property manager trying to fix things, and I was wondering, how do expenses go down every month?
Kim Alexander,
I remembered,
the former asset manager of Appleway, said Gajavelli refused to buy new air conditioning units when old ones broke down. So Alexander said she ferried working AC units from vacant apartments to ones where family with children were living without air conditioning. So they were trying to drive it up every single month. This is one of the units boarded up.
Number one, they're not at full capacity. if they've got vacant units to steal ACs from, then they weren't fully rented up.
They weren't fully leased.
And this is the underside of this that I saw in the article. Like, this was a lower income neighborhood, lower income housing. And so one of two things is happening here. Either these tenants are just moving out when all these increases are going up, or it's just, squeezing people that didn't ask for this to increase.
Yeah.
And there is market forces at work for rent, but what this article made it sound like is a rise in syndicators looking for opportunities to find under market places and just ratcheting up that rent really fast.
And the article talked about it first when there was mispricing in Class A property, Class A apartment rentals. Then those got maxed out. Then people went to B, and then people went to these C level apartment complexes. And that's just the nature of it. Is there was more appetite for these investors saying, I want to throw money into real estate. Now, if this had been a wealthy person's own money, I don't think they would have touched this deal. And the reason is how they got wealthy is they got wealthy by not extending themselves inappropriately in Class C projects. They sit around and wait till they find one. And for some people, that's years and years of looking for a new real estate project before they buy one. Well, you can't do that if you're taking a bunch of investor money. They want to see their money go to work somewhere. So you roll the dice and you hope it works, and it doesn't always. So let's go back to our video. We'll keep going back to the article when we hit something that's nails the article.
Down expenses. That's the way we improve the value of the property down the road. For example, we do water conservation. We change the old toilets with the new toilets. They take less water consumption, and we reduce the water bill around 25 to 30%. And also, not only that, we do electricity conservation. We change all the old bulbs with new LED bulbs. We cut down electricity bill by 15 to 20%.
Now, I'm not
cut out AC units will reduce the electricity bill.
Dude,
sorry.
You're exactly right. Yeah, literally, they are cutting out the AC units.
Yeah.
But there is no way LED bulbs in a Texas summer save you 20 to 30%. But if you're listening to this, wanting a syndicate to invest in, or your friends have just invested in it, it's so easy to overlook that. Especially if you watch some of his other videos where he talks about I was a engineer and working these big corporations and I wanted the passive income and all that. And it's compelling. And it's kind of a cool, like self-made immigrant story, all of that. Just turned out to cost people millions.
So that by cutting down water expenses and also electricity expenses, and increasing the income on the property and also other income is a terrific combination. That's why the property value will go up down the road because we're increasing net operating income month after month.
Okay, now one thing you have to ask yourself in any of these syndicates, when you're considering buying something and then the syndicator is going to improve this, that, and the other thing and raise rents, you want to ask yourself, why did the prior owners not do this? Like, this makes it all so much better. Why did the prior owners not want to do it? Well, it might be because the prior owners are finding it's not as profitable as all these people say, or the current owners. Now, it could also be situational, like, hey, it was inherited, the kids don't want it, they want to sell it. But there is some reason why the prior owner didn't do all of these things. And that's a relevant question to ask if you're going to put your hard-earned money into a deal like this.
And with a syndicate kind of deal, like, it would be one thing if it was a single family home and it's, the kids inherited, they don't want to deal with it. Absolutely. This is institutional level. It's a bigger investor owning this, like someone is treating it like a business. So they're more thinking about it that way. Usually it's not just one kid inheriting. I mean, it could be. But the other question is, why didn't someone, if the owner wanted to do this, maybe they didn't have the money, but why didn't a bank lend them the money to make those improvements? Exactly.
Right. They're going to lend it to you. Why wouldn't they lend it to the guy who already owns it? Right. I think those are all relevant questions. And of course, one of his other money-saving ideas was putting no chlorine in the pool. Where's that picture? There it is.
Supply chain, yeah,
they saved 100% on their chlorine bill, and I don't think it helped. Okay, let's get back to it. I wish I could do his accent. I would do an impression of him, but I'm just not good.
I think it's better we don't. Yeah.
No, if we have a Southerner on here, I'm going to make fun of him because I can do me some serious Southern accent.
So it's an amazing investment opportunity here. And we have great track record with our company. We bought 20 multifamily properties so far. And out of the 6,000 units portfolio, out of 20 properties, we already sold 3 properties. And
okay, so now I'm going to go to a little bit around some of these other articles. So this is the Family Multi Dive. And one of the things it talks about is that these 4 properties, that is the Heights at Post Oak, Redford Apartments, Reserve at Westwood, and Timber Ridge Apartments, have all been foreclosed on. Those are a total of 3,200 units. Now,
so half of what he said he had.
And 3 of them had already been sold, he said. So however many that was, I don't know how much this Appleways got left. As a little bit of a preview, while we're at it, and this is kind of fun, we just go through his own video, and that's guiding us through, showing you guys the rest of this information. This is their website currently. Apple's Way Group appears to be down, and then I tried his Calendly link, and it didn't work either. So they are shutting down at least outward communication. But let's keep going on our video.
Portfolio, out of 20 properties, we already sold 3 properties, and within less than 3-year hold period. And we double the money for investors. It's a proven business model. Same thing we do for this property also.
Okay.
Just because someone else says it's a proven model doesn't mean you have to believe that it's a proven model. A 3 property trend does not equal the outcome you wanted. Yeah, I think is the lesson there. Now, so let's get back here and see what he's got to finish saying. We're almost done with this, guys. It's just too much gold.
We use depreciation on each property. We use bonus depreciation. Your money will depreciate more than 100% in the year 1. In fact, 2022, 2021, we are doing bonus depreciation this year alone. Right? So you get depreciation benefit and the paper loss. It is a tax. Is like a legal tax-free investing.
Okay. So when you take depreciation, that means that like in commercial real estate, I think it's 37 and a half years, you can straight line depreciate commercial property. But you can do something called cost segregation analysis. And if you owned an apartment complex or even a regular house, you can say things like AC units depreciate more quickly, outlets depreciate more quickly, and the pool might depreciate more quickly. And as a result of those things, you can take faster depreciation.
Did happen.
Yeah, that pool did depreciate. I don't know if the IRS agrees with its depreciation.
Pool here. Poor pool.
Poor pool. The poor families live. Yeah. I mean, listen, I've been in Texas. That thing is breeding some mosquitoes the size of chihuahuas. that is a health hazard. So they're bringing up all of these tax write-offs, which is actually where we're going to end today, is on these tax write-offs, because we're going to tell you this gentleman is a big fan of these tax write-offs.
Multifamily. I'm so excited about the depreciation benefit and tax advantage for this property. And this is together. If you add all the things, right, increase income, cutting down expenses, and depreciation benefit and tax advantages, amazing investment opportunity. If you really want to money work for you, if you're really looking to truly passive income, if you want to create a legacy for your family and ongoing income for your children, and this is the best investment opportunity. Please click on the link below and get more info.
I'll just say on that part, if anybody ever says this is the best investment opportunity, run. And the reason you need to run is that they couldn't possibly know. A, can't see in the future. B, they haven't looked at every single investment opportunity out there. C, you're watching this video that is just floating around the internet from December 16th, 2021. Sorry, I thought it was early 2022. This one was December 16th, 21. And he has no idea what your demographics are, what your family is, what your situation is. It's the best for you. Run. That is only a technique to get the most amount of people to invest with the lowest possible understanding of the investment process or accountability for him as the general partner. That's the only people that are going to get connected to it. So some of the other things from this article that really go ahead.
We haven't even talked about the main reason why this all went south, which is his financing strategy.
Oh, wait, right before his financing strategy, I got to show everybody these comments.
Oh,
investment highlights. Now, I want you guys to know, if you're listening on the podcast right now, I'm going to do my best to describe the emoji next to all the investment highlights. Like, this is so bad. It literally says like, Miranda, can we do this as a short and have them like put Corey and I at the bottom here? And then we're going to explain each of these and you don't need to take this out of the podcast. I think our audience enjoys some of this stuff. Put it right above our heads. So when people flip through their phone, it's all these investment highlights above our heads. So we'll start and try to describe this. It appears to be money with wings, and it says 17.9% target IRR, 100% target.
And by the way, target, that's what they would like. We would like to get that, but it's not what they did. But I see this all the time. We have that target rate of return. Like that's your expectation. No, I've been in lots of business planning sessions with lots of business owners and entrepreneurs, and huge targets are all real exciting, but they don't always.
They don't work. Targets of the future have no correlation with our results in the future, and that would be a great disclosure. So that's the flying wings on the 17.9% target IRR, which, by the way, no investment advisor is allowed to say over 12 without getting themselves in trouble. 110% target total return in 5 years. 22% target average annual returns. So 22% cash flow. 10% target yearly cash flow. I have no idea how they would calculate one versus the other. None of their math is showing. You'll notice. Then there's a very strong arm, and it says top multifamily market in the nation. proven track record with 6,000 plus units of multifamily. I think his next video is going to say something different. It'll say track record instead of proven. Like, they'll just take the proven out. And then accelerated job and population growth with a very small graph next to it. Then you could schedule a free strategy call. I think you should, because that has the fire emoji next to it. Oh, also, I did try to click on that book a free strategy call. That's the link that didn't work. And then none of their website works out. So, Corey, you were going to tell them how this all ended up this way.
Yeah. So they financed all this whole acquisition with variable interest rate loans in a, when loans were being offered at 3.5% and 3.5% for a commercial enterprise like this is an amazingly low interest rate.
And if you wondered how they got it so low, it's because they said, well, you don't have to fix it for 30 years. We'll take a variable interest loan. And do you think that might have had something to do with how well all of the projections cash flowed? I think the difference between 3% and 8% would do it. This is our gentleman here featured in the article. I think he didn't respond to any inquiries on this article. Syndicators, 37%. I'm getting to that mortgage rate piece you were talking about, Corey, because I think it went from like 3.8. Many syndicators are racing to either raise funds or sell properties before tipping into foreclosure. Most hold balloon payment loans that require payment when they come due this year or next. Mm-hmm. Those syndicators face large payouts at a time when getting new, more affordable property loans will be difficult. Even firms with multi-billion-dollar portfolios have used syndication to buy apartment buildings that no longer make enough money to cover debt payments.
So here's the summary of it for me is, let's just go with this guy was an honest entrepreneur who thought he was, believed everything that he was saying.
And certainly I think thought he could do it.
That was the case.
Yep.
That is almost it's not really worse, but it's almost worse for me than someone who is knows what they're doing is wrong, is trying to cheat someone. Because that person who's trying to cheat you, you can actually more predictably guess what their behavior is going to be, because they're following. They know the difference between real and not real. This guy thought he was doing something amazing and was missing some major pieces about how this deal was going to succeed or not succeed. I mean, the reason he went down is essentially a repeat of the entire 2008 mortgage crisis. And he didn't learn anything from that.
He wasn't doing this then. He was a software engineer then. He, to Corey's point, he probably believed he could do all of it. I don't think they're going to find fraud. I think what you're going to find is incompetence. Mm-hmm. And incompetence is a harder one because there's lots of incompetent people, enormously naive and incredibly enthusiastic. And those are some of the biggest ones to watch for, because you don't even feel good about calling the guy to the carpet because he believed it too.
Right.
But in reality, if you're an investor in that, you still lost money. So I'll give you guys a little bit of the end of the story of this property. Last July, Houston Mayor Sylvester Turner visited the Timber Ridge Apartments and threatened legal action. The situation that people are living in right now is deplorable, Turner said at a news conference in the property's parking lot, and none of us would want to live with it. The tenants were desperate, said Mitzi Ortez, a former staff member of the nonprofit Texas Organizing Project, the group that had worked with a complex, mostly low-income, Spanish-speaking tenants to get help from the city. For most of 2022, Applesway sent brief updates to investors about the company's various properties, as well as monthly cash disbursements based upon the amount of their investments. And that is something that happens in a lot of these syndications. But this is the key, is that when something goes wrong, you find out about it, all the volatility, right at once.
Yeah.
Sinha said the first big sign of trouble came this year in late February email.
And Sinha was an investor in this syndicate. It was one of the early and biggest, I think.
Gagliavelli asked investors for additional funds to shore up the property finances of the Reserve at Westwood, the Houston apartment complex he had invested in. I want to let you know that things are not going well. He's quoted from the letter. Applesway was losing money because of higher mortgage costs, the result of much higher interest rates, the email said. Property taxes and insurance costs were up, and as the company moved to raise rents, more tenants fell behind on their payments. And you referred to that earlier, Corey. In March, Gagliavelli told investors no money was needed after all. Spoiler alert, not for a good reason. In early April, he sent investors... In March, he says, hey, we don't need the money. We're good. We don't need it. But in April...
He could have asked for more and more money and run away with it.
Yeah, agreed.
Right? He wasn't doing that. Yeah.
Totally agree. In early April, he sent investors letters telling them the buildings had gone into foreclosure. And he says, few things are more painful than having to notify investors of a failed business. Now, that part also very honest. This is a business, not an investment. That is a prophetic truth that when you are buying into a piece of real estate, you're buying a business that has a customer, the renter, it has profit and loss, it has equipment, and it needs to be managed like a business. You can't set it and forget it. And if you're in a syndicate and that manager isn't enormously honest and highly, highly competent, you're not going to get the returns anywhere near what were promised. Gagliavelli offered a silver lining. We suggest you contact your tax advisor to discuss how your investment loss can be recognized on your tax filings. So Will Parker and Conrad, it looks like Putzier, and Shane Shiflett. Cool last name, Shane Shiflett. Great article. Glad that you brought this forth and that we were able to find some of these other sources like the Dive report that was able to give us this additional information. So thank you, all of you, for doing this. And what we hope is you guys see this, you're going to see the next real estate investment fund. You're going to see the next, we're going to buy crypto for you. You're going to see the next, we buy nothing but cold stone creameries and flip them. Whatever it is, you are expecting somebody else's human capital to go to work on behalf of your financial capital. Now, next week, we're going to dig in and talk about why that doesn't necessarily always work. But more than anything, we hope for all of you out there, you get a chance to take a look at this. If you're in a real estate syndicate, start watching it closely. It can't hurt for the Gagliavelli of your investment to know that people are watching closely, that people want to have that information, want to be on the inside of it. And if you're in one of those projects that got rising interest rates, et cetera, it might be way too late and there's nowhere you can go with it. But if you're somebody who's been pitched these, maybe you've just stayed out of it and haven't done it, and you're looking for an advisor that understands this kind of stuff, then reach out to us. You can get us at info@sfgwa.com. Of course, you can comment below. Be sure to subscribe to the channel. And you know why I think it's important that you subscribe? Because I've subscribed, guys. Look at this. I'm just going to prove it to you guys. I have officially subscribed to our YouTube channel. I was afraid to have Corey show his. He's probably not subscribed, just like you. But you guys can be subscribers.
Podcast is that smooth-cheeked young man. Haven't seen him in a while.
So we appreciate you guys being here. We appreciate you putting stuff in the comments. Don't hesitate to put something in there. Hey, I want to see a show on X, and we'll be happy to get it in the lineup. And with that, and as always, from Corey, from Miranda, and from me, I hope you listen to episode 109. I meant to tell you that earlier. That is the Be Your Own Fiduciary podcast, and we hope that this show has been a contribution to you being able to design and build a good life.